Hey everyone, and welcome back to the channel. Today, we're diving into a powerful strategy that can significantly lower your tax bill: tax loss harvesting. It might sound complicated, but I promise by the end of this video you'll understand exactly how it works and how you can use it to your advantage. So if you're an investor in the US looking to be smarter with your money, you're in the right place. So what exactly is tax loss harvesting? Simply put, it's the practice of selling an investment that has lost value to realize that loss. You can then use this realized loss to offset capital gains you might have from selling other investments for a profit. By offsetting your gains with your losses, you reduce your taxable income, which means you pay less in taxes. Think of it as turning a market downturn into a tax-saving opportunity. It's not about being happy your investments went down. It's about making a strategic move when they do. Let's break it down with a simple example. Imagine you invested in 2 stocks this year. Stock I you bought for $10,000. And what if your losses are bigger than your gains? That's even better news for your tax bill. Let's say you have $5,000 in capital gains, but $8,000 in capital losses. The first $5,000 of losses will completely wipe out your gains, so you pay zero tax on them. What about the remaining $3,000 in losses? The IRS allows you to use up to $3,000 of excess capital losses to offset your regular income each year. That's your salary from your job, for example. This directly lowers your adjusted gross income, potentially putting you in a lower tax bracket. And if you have even more losses left over, you can carry them forward to future years to offset future gains or income. It's a powerful tool that keeps on giving. Now, there's a very important rule you absolutely must know: the wash sale rule. The IRS created this to prevent people from gaming the system. A wash sale occurs if you sell a security at a loss and then buy the same or substantially identical security within 30 days before or 30 days after the sale. That's a 61-day window in total. If you trigger the wash sale rule, you're not allowed to claim that loss for tax purposes in that year. The government basically says, nice try, but you didn't really get rid of your position, so you can't take the tax break. So you have to be careful. So how do you avoid the wash sale rule while still staying invested in the market? The key is to sell your losing investment and then immediately reinvest that money into a similar, but not substantially identical investment. For example, if you sell an S&P 500 index fund, you can't buy the exact same S&P 500 fund from the same provider. But you could buy a different S&P 500 fund from a competitor, or perhaps a total stock market index fund. The goal is to maintain your desired market exposure and asset allocation without violating the wash sale rule. This way, you capture the tax loss without missing out on potential market recovery. Who benefits most from tax loss harvesting? This strategy is most effective for investors in higher tax brackets who have taxable brokerage accounts. If you're in a 0% long-term capital gains tax bracket, there's less incentive. Also, this doesn't apply to tax-advantaged retirement accounts like a 401(k) or a Roth IRA, because the growth in those accounts is already tax-deferred or tax-free. Tax loss harvesting is specifically for your taxable investment accounts where gains and losses have immediate tax consequences. It's especially useful for active investors or those with diversified portfolios where some positions will inevitably be down while others are up. So when is the best time to do this? Many people think about tax loss harvesting only at the end of the year, in November or December, as they're getting ready for tax season. And that's fine, but you can actually do it anytime throughout the year. Market downturns and volatility can happen at any moment. By regularly monitoring your portfolio, you can seize opportunities to harvest losses as they appear, rather than waiting until year-end when the opportunity might have passed. Being proactive allows you to be more strategic and potentially capture more significant losses. Let's quickly recap the steps. First, identify investments in your taxable account that are currently valued below your purchase price. Second, sell that investment to realize the loss. Third, to avoid the wash sale rule, either wait 31 days to repurchase the same investment, or immediately reinvest the proceeds into a similar but not identical asset. Fourth, at tax time, use these realized losses to offset any realized capital gains. Finally, if you have excess losses, use up to $3,000 to offset your ordinary income and carry the rest forward. Tax loss harvesting is a smart, legal way to lower your investment-related taxes and make your portfolio work harder for you. It turns a negative, a losing investment, into a positive tax benefit. While it requires a bit of attention, the savings can be substantial over the long run, leaving more money in your pocket to reinvest and grow. Many robo-advisors now offer automated tax loss harvesting, which can make this process incredibly easy if you prefer a hands-off approach. And that's your ultimate guide to tax loss harvesting. I hope this breakdown made it clear and easy to understand. It's a fantastic tool for any serious US investor. If you found this video helpful, please give it a thumbs up. It really helps the channel grow. And don't forget to subscribe and hit that notification bell so you don't miss out on more tips to make you a smarter investor. Thanks for watching, and I'll see you in the next video.